Video T10B is on partnership taxation. This is notoriously one of the most difficult areas of taxation. My job is to give you just enough without drowning you. We'll see how I do. When two sole proprietors decide to go into business together, that's when a partnership is born. This is true even when it's husband and wife. Now, typically we think about two partners splitting everything 50-50. But partnership agreements can be written in a number of ways. For example, what if partner 1 brings a great idea and partner 2 brings the capital? If they do not perceive the risk as equal, there is some chance that the reward would not be shared equally. Maybe the capital partner does not agree to enter the deal without an extra reward. For example, the capital partner demands a return on his capital before any income is allocated to the idea partner. Partnership agreements can build in this type of sharing arrangement. Partnerships are often constructed in a handful of forms. These can have different characteristics that are frequently desired by investors. The most common form is a general partnership, where partners all exercise the right to make decisions for the partnership, and they are also all responsible for the partnership debts. Some partners are not interested in the liabilities of the partnership. They might also be willing to simply invest and serve as so-called silent partners. For them, a limited partnership might make a better choice. The limited partners are shielded from liability, but are unable to make decisions for the partnership. That is left to the general partner or partners that are required, even in a limited partnership. A special limited partnership is the limited liability partnership. LLPs are largely used by professional service providers because they allow liabilities due to partner negligence to be tied only to the partner or partners that committed such negligence. At some point, taxpayers were seeking the liability protection of a corporation with the flexibility of a partnership. The limited liability company was born, and soon every state offered this type of organization. LLCs permit limited liability. After all, it's in the name. They permit flexibility in ownership rights like a partnership, and can also have a single owner, unlike a partnership that requires at least two. LLC owners are typically called members, and a single member LLC is disregarded as a separate entity and is treated like a sole proprietor for tax purposes, making this form a good choice for a sole proprietor seeking some liability protection without the double tax of a corporation or the complexity of an S corp. Partnerships and LLCs are both taxed as partnerships. Partnership tax law provides for no tax at the entity level. Instead, the income is allocated to the partners in accordance with the partnership agreement. Since the income flows through, it retains the same character in the hands of the partner as it did in the partnership. For example, if the partnership generates a capital gain, that capital gain income is reported to the owners as capital gain. Tax exempt flows through as tax exempt, etc. This differs from a corporation, where income is only recognized by owners when a dividend is paid and takes the character of dividend income regardless of the type of income earned by the corporation. For example, tax-exempt income can be converted into a taxable dividend. We're also going to see that basis is extremely important with respect to partnership investment. Speaking of basis, let's talk about Jack and Jill. They did not go up the hill, but they did form a partnership. They were both a little short on cash, so they borrowed money from the bank to fund the partnership. Similar to investments in property, the debt does not affect Jack or Jill's basis. Mac and Lil also formed a partnership, but slightly differently. Instead of personally borrowing the money, Mac and Lil's partnership borrowed the money. As general partners, Mac and Lil are liable for the partnership debts. In both cases, the partnership has cash and the partner's debt. Since there is no economic difference, it makes sense that partnership liabilities are treated the same as if the partners took on the debt. In fact, many times an increase in partnership debts is called a deemed contribution by the partners. We'll cover more on basis later. In the meantime, let's talk about income. Recall that the character of income stays the same when allocated by a partnership. As an example, if a partnership generates some ordinary income, some capital gains, and some tax-exempt income, as a partner, if all that was reported to you as a single lump sum, you would end up paying ordinary tax rates on all the income, and thus miss out on the preferential tax rates for capital gains and tax-exempt income. As a result, partnerships are required to report ordinary income as a single line, but other forms of income are what are called separately stated items because, well, they're separately stated. Partnerships are required to prepare an informational tax return, Form 1065. This reports the income and separately stated items for the entire partnership. The partnership also prepares Schedule K-1s for each partner that report their individual share of the income and separately stated items. Partnerships' income allocation and cash flows do not necessarily match. For example, if Jack and Jill's partnership, J&J, generates ordinary income of $10,000, that income is allocated to Jack and Jill. This is true whether or not the cash is also distributed to Jack and Jill. If no cash is distributed, it's like the $10,000 of cash was distributed, but then immediately reinvested in the partnership by Jack and Jill. If on the first day of the next year, Jack and Jill receive a contribution from J&J of $3,000, the reality is they are getting the cash that was generated by the income they reported in the previous year. Partnerships do not suffer double taxation, and so the cash is not taxed when distributed. To make sure that the cash is coming from the income earned in previous years, partners are required to track their basis in the partnership. We will get to more of this shortly, but first, let's take a peek at Form 1065. Besides the partnership information at the top of page 1, the partnership also reports the items that make up the ordinary business income of the partnership. You can see the income on lines 1 through 7 and the expenses on lines 9 through 20, with total ordinary business income on line 22. That carries over to line 1 of Schedule K of the Form 1065. This is where the partnership reports the totals of the business income and separately stated items that partners need to report. Items like dividends, capital gains and losses, 1231 gains and losses, tax-exempt income, and other information are reported here. Each partner then receives a Schedule K1 that reports their share of the income and separately stated items. There is a one-for-one match between the lines of the K1 and Schedule K. For example, line 1 on both is ordinary income. If each partner's K1 line 1 was totaled, it should equal the amount on line 1 of Schedule K, and the same is true for all of the lines. Think of Schedule K as the mama and the K1s as the babies. A unique separately stated item is something called a guarantee payment. This is very similar to a salary paid to a partner, because partnerships do not pay wages to partners. They can pay wages to employees, though. Guaranteed payments are unique in that they are both a deduction in computing ordinary income and also a separately stated item, since the partner that receives the guaranteed payment needs to record the income. As previously mentioned, income allocation and cash flows do not always match timing. Let's start with the Jack investment of $10,000 into the partnership. At the end of the year, J&J reports $5,000 of ordinary income to Jack and $500 of capital gains to Jack. Then J&J makes a cash distribution to Jack. Let's see how these transactions affect Jack's basis in the J&J partnership. We'll start with a zero cash distribution to Jack. Jack gets basis for his investment in the partnership, just like he would if he invested in a stock or a bond or some other investment. Jack also increases his basis for the income and separately stated capital gain. Recall this is like Jack received the cash and reinvested it back into J&J, in spite of no cash actually changing hands. Since there is no distribution, Jack finishes the year with basis of $15,500. In the second column, J&J makes a $3,000 distribution to Jack. Since Jack's basis before the distribution is $15,500, the cash distribution is either a distribution of the $5,500 of income already allocated to Jack, or is a return of his $10,000 investment. Either way, it's not taxable. In column 3, the distribution is increased to $14,000. Similar to the previous column, the $14,000 is a return of all of the $5,500 of income reported to Jack, plus an additional $8,500 return of Jack's initial investment. Again, either way, it's not taxable. However, in the final column, the distribution to Jack is $20,000. This is all of the $5,500 of income and all $10,000 of his initial investment, plus $4,500 that must have come from somewhere else. When you receive someone else's money to keep, that's income, and thus distributions in excess of basis are treated as income, and Jack's basis is decreased to 0. So you can see that the calculation of basis is important for partnerships because of 3 particular reasons. Number 1, it determines whether distributions made to the partners are taxable. Number 2, we're going to see that it places a limit on the amount of losses that are permitted to be deducted by the partners. And number 3, of course, it represents a tax-free return if a partner sells his partnership interest. So just as income increases basis, losses decrease basis. So let's go through our same example with Jack and J&J, with the $10,000 invested, $5,000 of ordinary loss allocated to Jack, but a $500 capital gain allocated to Jack. So in column 1, again, we have no distribution. The deductible loss is deductible because there is ample basis before the loss is deducted. And in fact, Jack ends the year with basis of $5,500. If J&J makes a $3,000 distribution to Jack, then Jack's basis before the loss is $7,500. That's still enough to absorb the deductible loss and leaves Jack with $2,500 in ending basis. If, on the other hand, Jack makes an $8,000 distribution, well, now Jack's basis before the loss is only $2,500. As a result, Jack is only able to deduct $2,500 of that loss. His basis goes to 0, and the additional $2,500 of loss is what's called suspended, which means it can be carried forward. In the instance of a $20,000 distribution, then we already know that this distribution exceeds Jack's basis. As a result, that's going to 0 at his basis. The excess $9,500 is going to be taxable to income. And as a result, none of the $5,000 of the loss is deductible, and it's all going to be suspended. Okay, so partnerships and LLCs are actually taxed in the same way, but there are a few differences between them. For example, LLC members have limited liability. As a result, they remain shielded from the LLC stats. You, of course, cannot have a single partner partnership. You need at least 2, whereas you are allowed to have a single member LLC. Another difference is employment taxes for LLC owners and employees are a little bit muddier in terms of the tax law than they are for partners and partnerships. Okay, so before we leave this area, we of course have to talk about the new tax law that introduces the Qualified Business Income Deduction, or QBI deduction. This deduction is 20% of qualified business income, and it's deducted on the individual owner's tax return. So this is not something you're going to see on the 1065. So if Marge owns 50% of an LLC, and that LLC allocates $100,000 of income to Marge, as long as Marge's taxable income is less than $157,500, which is the threshold for the QBI deduction for single taxpayers, then Marge is eligible for a QBI deduction of 20% of her pass-through income, or $20,000. And the QBI deduction is a from AGI deduction, which means it's below the line.
So the QBI deduction applies to most forms of pass-through income. That includes sole proprietors, partnerships, LLCs, and S corporations. As I mentioned before, there is a phase-out if the taxable income of the taxpayer is above $315,000 for married filing jointly, or $157,500 for all other taxpayers. There's also a phase-out at the same income levels if the business is a personal service business, for example, doctors, dentists, accountants, lawyers, consultants.
Wow, that was a lot to take in. Dealing with flow-through taxation often takes a little bit of getting used to. We're going to cover S corporations in the next video, so we're going to see some more. Thanks for watching.